Welcome to the deep dive. Today, we're tackling something I think, well, everyone struggles with at some point. Your brain versus your portfolio.
Mm-hmm. That internal battle.
Exactly. Our mission here is to pull back the curtain a bit, see how our own psychology, you know, fear, greed, maybe a little overconfident,
Oh, definitely overconfident sometimes.
right, how that can mess with our investment plans. And crucially, figure out how you can actually fight back.
Indeed. And we've looked at some really surprising insights from investment legends. We want to show not just what tends to go wrong, but also why it matters for your financial future. And then maybe find that common sense path to better results.
Okay, so let's get into this core conflict. Our sources, they really highlight how emotions, basic things like hope and that gut-wrenching fear,
They drive so much.
they really do. They cause these wild variations in speculative return. And what I found really interesting was this idea that being a smart investor is, quote, a trait more of the character than of the brain.
That's a key point. It's not just about being clever or having a high IQ.
No. It means your emotional control, keeping calm when things get chaotic, or resisting that urge to chase the next big thing that's maybe more valuable than pure brain power.
Mm.
It's about managing yourself, as much as managing the money.
And what's fascinating there is what one source called the incorrigible tendency, like this stubborn habit the public has.
Incorrigible, I like that.
Yeah. To chase action or the hot trends, it's often fueled by, well, heedlessness and greed.
So basically jumping in without really thinking, hoping for quick riches.
Precisely. And this often leads people to take undue speculative risks.
Hmm.
You hear about these miracles promised by some managers, but more often than not, it ends in losses.
It's a pattern, isn't it?
A very common one.
Okay, so if battling our own impulses wasn't hard enough, there's this other thing our sources brought up. A quieter drain, maybe?
Uh-huh.
Costs?
Yes, the tyranny of compounding costs. And here's where it gets, well, potentially quite painful for your bottom line.
These sources show how seemingly tiny fees just eat away at your returns over time. Things like high expense ratios.
The annual fee for the fund.
Right.
Yeah.
And those hidden 12B1 fees for marketing, plus portfolio turnover costs.
All the buying and selling the manager does adds up.
It really does. One example we saw showed costs eating, get this, 25% of a 10% return. A quarter of your potential gain gone.
And let's be clear, connecting this to the bigger picture.
Mhm.
These fees, these transaction costs, they're absolutely paid out of your pocket,
Your money.
your money, and they provide, quote, no net benefit whatsoever to you. Think about that. Giving away potentially a quarter of your growth each year.
Over decades. That's huge.
It's massive. The evidence really is compelling here. Lower costs unavoidably lead to higher returns. It's one of the few things you really can influence directly.
So, okay, we've got our own psychology working against us. We've got these hidden costs. But what does this actually mean for your portfolio? What's the strategy?
Well, the focus shifts, doesn't it?
Yeah, what can we control? Our sources really hammered this home. Focus on risk, cost, and time.
Exactly. Those are the levers you can actually pull. Risk you're comfortable with, keeping costs down, and letting time do its work.
That feels more empowering. But
Yeah.
how do you actually do that? How do you simplify?
Good question. The ideal of long-term investing, according to the research we looked at, is often best achieved through low-cost, passively managed index funds.
The simple approach.
Simplicity writ large, as one source put it. You avoid trying to pick the next superstar manager, which rarely works out long-term after fees anyway.
Right, chasing past performance.
Yeah, that futile evaluation of past returns
Yeah.
tells you very little about the future. The data consistently shows these low-cost index funds outperform most active managers over time.
Why? Because they minimize those costs and take the emotional guesswork out.
That's a huge part of it. Lower costs, less damaging behavior.
So this deep dive, it seems to show that real investment success isn't about complexity or, finding some secret formula.
Not at all.
It really comes down to disciplined character, managing yourself, and just focusing relentlessly on those simple, controllable things.
Manage your emotions, keep those costs incredibly low, and be patient. Let time be your ally.
Simple, but maybe not easy.
True. Which brings us to the final thought, really. Knowledge is one thing, but it's only valuable when you actually understand it and, crucially, apply it.
Right.
So the question for you is, will your next investment decision be driven by that fleeting emotion, that complex allure? Or will it be guided by these enduring principles of common sense and control we talked about today?